JB Cycles here with an extra video on September the 25th. So I studied the weekly data for the S&P back to the 1950s and comparing this year's price action with previous bear markets and looking for similar patterns and what to expect further from here. So I'm not going to show you the whole analysis, but sum up my conclusions, so you just have to trust me on what I have found. What I see, it's unlikely for us to make a double low here and end the bear market and rally from here. Just going to quickly show you this kind of bear market we are in now. We have seen something similar in 2008 and 2001, and then we have to go back to the 1970s where we had a couple of real bear markets, although not all of them very deep. Some of them had deep bear markets, but anyway, switching back to my conclusions, what to look after from here is a lower low. This rally up from June has failed, and we should not have a double low here. We should have a lower low. Time-wise, it looks like we should look for a low around November. And the downside from here, it should be around, could be 8% lower low than the previous low in June, but it could be less, it could be more, but I find an average target around the level 3,400, and that, when you look at the chart and some lines and levels, that's an obvious level. You have this general trend channel, and the lower part of it is around 3,400, and that's also the top before the COVID crash, and you have a consolidation area here. So this level here in red, I have the distance to the 40-week moving average, and if we go down here, we should be as oversold as we were in June, and I'm expecting at least we should get as oversold as in June, possibly lower, but also marginally less oversold is possible. So this low around November could be the bear market low. It's 40-week cycle low, and it's a 20-week cycle low, but the most probable scenario is that we bounce up near this previous low in June, and then early next year we start to flush down to a lower low, and that's call it the capitulation low. And it could be around the next 20-week cycle low around, I think, March, and it could also stretch into the next 40-week cycle low around July, I think. So that's my most probable scenario. We could also see, if this is the bear market low, we could rally and break the 40-week moving average. That's equal to the 200-day moving average. So if we break that one, bear market is over and we rally. I could also see a possible scenario where we rally up to this level and then turn sharply down. But I think then this bear market doesn't have the correct bearish momentum. So here that could end up with a higher low, or possibly it could make a bit lower low, and then it's all over. But in this scenario, I don't see a very deep and bad bear market. So we need to see bears in control and not rallying into New Year much higher than 3,700, and then we will have a very bad next year. So that's kind of my obvious conclusions from the chart, but I kind of got it confirmed by checking previous data. So I have a downside target around 3,400, and time-wise around November. So very short term, I could see us consolidate around this area for a couple of weeks. We could break a little below, then try to backtest and then flush down. So we have different variants possible here. But yeah, that's my addition to yesterday's video. See ya!